So right now there's this ongoing war between the US, Israel, and Iran. The core issue here isn't just geopolitics, though. The price of oil obviously goes up given the current events. About 25% of the global oil movement is transported through the Strait of Hormuz, which is an essential pipeline. The global energy system grew around this geography, so it's not easy to replace this way of transport overnight. The Middle East has huge, cheap reserves, and the Strait of Hormuz is the shortest export route. There are two key benchmarks, Brent and WTI. In a situation like this, Brent is actually what is exposed to risk in the Middle East more. Right now, it's above $110 per barrel, while the WTI is only $90 per barrel. That is a major spread of two commodities that are normally very closely linked. It's natural that the effect of higher oil price doesn't just affect transportation. It affects everything because those transportation costs transmit into the price of all other things in the economy. Inflation is very closely linked to price of oil. The February inflation stood at 2.4% year over year, which is slightly above the Fed's 2% target. However, it's important to keep in mind this number was the last inflation number before the conflict in Middle East began. The pipeline naturally goes to consumers and producers who are dependent on oil. Fossil fuels play a huge role with regard to stocks and bonds, but also to the overall economic health. We believe there is a slight short-term risk of inflation. We've had the first major inflation wave in 2021, then monetary policy restriction, rates going up, and then inflation cooled down with response to that. The COVID era that began in 2020 and 2021 carried a heavy monetary stimulus for locked-down businesses, and that led to excess demand, a demand shock in form of new dollars. But there's one other thing to keep in mind. The long-term target for inflation is around 2%, which is widely perceived as the optimal rate of price growth in economy. Right now in February 2026, we see inflation at 2.4% is kinda in that target. That's fine. But there's one other implication, and it is this. If the long-term target is 2%, and during some periods we went up to 9%, then that means it would now have to be much lower than 2% to see the long-term target being 2%. Because right now it appears the actual long-term inflation on average, say since 2020, is more around 5%. That is nowhere near the long-term 2% goal.
We're seeing the Federal Reserve has kept rates at the 3.5% to 3.75%. The reality is we might not see more cuts in 2026, according to the Federal Open Market Committee. While that's not certain, it affects how markets react. At the same time, equities have started to pull back. The S&P 500 has dropped to 6,400 points, down from roughly 7,000 earlier this year. The current situation looks like a classic bull trap. In this economic environment, oil plays a central role. The price of West Texas Intermediate specifically will influence how the economy will develop from now. The price of WTI oil, as mentioned, is $90 per barrel. What smart investors know, and this is crucial, is that the stock market valuations aren't the perfect telling of the economic state. The real insight comes from the bond market. If we really want to understand what's going on right now, we don't look at stocks, we look at the bond market, or more specifically the credit spreads. That's where the real signal is. A credit spread is just the difference in yield between safe government bonds and riskier corporate bonds with similar maturity. It's measured as the gap between something like the Moody's corporate bond yield and the 10-year Treasury. That gap is the price of risk in the economic system. When it's small, everything looks fine. When it starts widening, something is breaking under the surface. If we compare credit spreads with the year-over-year S&P 500, the relationship is pretty clear. It's almost inverse. When spreads rise, stocks struggle. When spreads are tight, stocks tend to move higher. The logic is simple then. Stocks follow liquidity, and credit spreads are a direct measure of how available and cheap that liquidity is. Think of credit as the bloodstream of the economy, just like bloodstream in the human body is the most essential part. Businesses need it to invest, households need it to spend. When spreads widen, lenders are basically saying, we don't trust borrowers as much anymore. That usually means higher default risk, tighter financial conditions, and less activity across the economy. And when that happens, stocks perform badly. We've seen this situation play out in late 1990s before 2008, 2015, 2020, 2022, and right now it appears the credit risk is growing again. The credit spreads are widening, which means that if the spread will widen and borrowers will be considered riskier, it will have a very negative impact to performance of stocks.
But it's important to keep in mind that if we look into the history, Such geopolitical events like wars in Middle East rarely cause recessions or crisis. A majority of crises are caused by shortage of liquidity, and a strong, expanding economy like United States historically had no problem absorbing shocks like the one that's happening right now. Such shock does not have to automatically trigger a recession. What can happen is these oil shocks can amplify an already happening trend. Good examples are the September 11th attacks or the 2008 oil shock. Both of these events came after the reversal in economy was already happening. 2008 crisis was especially visible long before it happened, and the 2001 decline was triggered by collapse of tech companies. While the September 11th event certainly caused vulnerable, turbulent environment, it could not have been a factor that would shake a strong economy. And for those who lived through 2008, they know that the oil shock couldn't have been a hit to an otherwise healthy economy. Quite the opposite. The key factor we view is this, and it is that the government has well injected massive amounts of money into the economy. This money has made corporations profit super well. In fact, U.S. corporations never had it so good like they do right now. We can see that on the corporate profit margins after tax. What this effectively means is the U.S. corporations are well positioned with their current profit margins. This chart shows the after-tax profit measure relative to GDP. Strong margins mean companies have it easier to lower their margins when shocks arrive. A problematic issue is when these profit margins are thin. We see that in 2001 and 2008, the profit margins were quite low. That ultimately was a very bad factor for the upcoming development at that time. It meant companies had little space to deal with shocks. What's interesting, though, is that around the global financial crisis in September 2008, central banks were reading the same environment in completely different ways. The Federal Reserve was already shifting toward rate cuts as financial stress appeared on horizon in the wake of Lehman Brothers crisis. The Fed recognized that the real risk wasn't inflation, but it was a breakdown in the financial system and credit markets, which required immediate support. At the same time, the European Central Bank was focused on rising oil prices and inflation, and actually moved to raise rates. In hindsight, that decision was a major policy error. By tightening into a collapsing financial environment, the ECB added pressure to an already fragile system, worsening the downturn across Europe and highlighting how dangerous it can be to prioritize inflation signals while missing deeper systemic risks.
When there's demand for bonds, their prices go up and yields go down. When their prices go down, their yields go up. That's what we're seeing now. The yields, not just of the U.S. Treasuries, but globally of many other government treasuries, are going up. We're seeing stocks and bonds move in sync right now. Prices of both are dropping. S&P 500 is now at 6,350. Meanwhile, the Treasury bond yield went to 4.42%. And there's another major asset declining right now, and it is gold. Gold ultimately is a monetary hedge against loose monetary policy globally. Gold should be going up at situations where central banks across the globe are printing money heavily. Because gold is preserving purchasing power. We've seen the price of gold drop from $5,500 to $4,400 per troy ounce. Now that's a heavy decline, indicating there was some sort of a bubble. Remember, we've seen historically such drops happening, mainly in 1980s, 2010s. That was when gold price reverted back sharply. None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.